Keith, I'm going to start off with you. What do you make of what seems to be a bit of a pullback in the so-called Trump trade?
Yeah. Well, first, great to be with you, Frank. I think we need some perspective. Let's zoom out. We had the biggest one-day post-election rally in history, and for the month, we're already up 4 or 5% after being up 25% for the year. So to me, this is really normal. It's a digestion, some consolidation. We still think the underlying trend is positive, and we're likely to see more gains before year end. But some choppiness, some consolidation is to be expected.
Yeah, Keith, I know originally your word of the day for us was going to be USA. In your mind, this, America First policies and things like that, I think we kind of saw a bit of a kind of a negative response to some of these proposals in the bond market yesterday. We saw bond yield spike a bit. Is that a concern for you going forward? We're looking at, just pressure on the equity market.
Yeah, so first thing on the Team USA, we've been overweight equities before the election for several years, and what we've seen more recently that has amplified after the election outcome. And then to your point about really on the short term, these yields on the 10-year as they approach 450, I think that's going to be a bit of a challenge. Credit spreads are really well behaved. Yields are moving higher because of inflationary concerns, the tariffs, and the economy is resilient. But I do think that poses a little bit of a short-term challenge for the market, and you're seeing that today.
All right, Mark, coming over to you. Very similar question. What do you think of this pullback when it comes to that so-called Trump trade, at least yesterday? Obviously, this morning, we're seeing Tesla rebound a bit.
Yeah, well, I think that, clearly we have a little bit of buyer exhaust, but I think a lot of us have stepped back and sharpened our pencils. And, a lot of the trade that we saw last week leading up until prior to yesterday were just continuations of trends and factors that we've been following leading up to the election. I think, though, let's say there are 400 anomalies to the efficient market hypothesis. One of the most powerful ones is momentum. But momentum can't operate alone without strong fundamentals behind them. So I think a lot of people are sharpening up their pencils. They're taking a look at what happened. And I think they're, giving some second thoughts to some of the things that went on earlier in the week. Bond yields are certainly putting pressure on the markets as well. And of course, the bond vigilantes are back out. I think they sat on the sideline for a few minutes watching things play out, but they're back and they're putting their message in and equities are responding.
CPI report coming up later today. Normally, that would be like, we'd all be on pins and needles waiting for that to happen. It doesn't seem to have the same weight as it did in previous weeks and months. But in your mind, is this a market mover? And if it is, what could be impacted if we get a hotter than expected CPI report?
I think you're right. I think people have sort of put CPI on the back burner a little bit. I mean, inflation has been coming down. The trend is going in the right direction. However, the market is on pins and needles. And at this point, for just about everything, I mean, you see the 10-year longer maturity, 10-year yields responding to certainly the potential for inflation. And of course, the tariffs are hanging over everybody's head. No one knows what to expect. I mean, we've all been talking about it. We know that they could be possibly inflationary, but it brings it back certainly, into top of mind. And definitely, I believe if you have some hot inflation numbers today, I think you can see further pullbacks, and you could see, the bond yields extend their gains certainly beyond 450. I mean, if you just look at the technicals, you could see that there's a little bit of room on the upside, and today's print could certainly make that happen.
All right, this is the fun part. We get a double dose of picks. So, Keith, I'm going to come to you first. What's your pick for us today and why?
Well, we still like technology, but when you're looking at technology, you have to actually go a little bit below the surface. And what we're really seeing is that the software side is starting to be leadership. And just as an example, not as a stock pick, because I'm not a stock picker, but Palantir just mentioned in their recent earnings report that they just automated the underwriting of a major insurance company from 2 weeks to 3 days. So just think about some of the productivity gains we're starting to see below the surface beyond semiconductors and the infrastructure side.
All right, so you're saying you play it with software. By the way, the IGV ETF, one of the popular software ETFs, up about 13% over that since election day. Chips actually lagging, only up about 3% or so. In your mind, is the chip trade cooling off?
It is cooling off, but it's also much more divergent. It's the haves and the have-nots, and the areas that are more leveraged to AI are doing better. So that's where we would focus. And going to your point about software, we've had a big run. I would say if we get a little bit of this pullback, even if we had a hot CPI report, we'd be looking at that as an opportunity for software, because we think that will resume leadership.
Mark, bringing you in as the closer, your pick for us today. I know you have a sector that you want to watch right now.
Yeah, so I'd agree with Keith. We like to focus. We believe that technology presents the greatest opportunity going forward, but selectively, as implied, because it's not necessarily in everything rally in technology. We have to now look more closely at supply chains, and that's certainly overhanging the chips sub-industry and the industry. But we see a lot of opportunity there going forward still, and we still like the AI ecology.